like the last comments that you made regarding the belief in central banks and the belief in the Fed, and the belief that because of the way that the Fed is behaving and the way that central banks are so-called manipulating the market, if you believe that something is happening, if you believe that because we have the internet, then we're not going to have a bear market, as people believed in 2000, if you believe that because we have railroads, in fact, the reason that Johns Hopkins, my alma mater, is not in the Ivy League is because the people who ran the funds, the pension fund for Johns Hopkins, had an important crisis because they were asked to join the Ivy League. But in order to join the Ivy League at that time, you had to have an undergraduate school, and Johns Hopkins only had a graduate school. And so the question is, how can they have an undergraduate school? Well, they need a lot of money to have to hire a lot of professors. And they looked at their endowments, and they looked at the money, and there was money in treasuries, and there was money in general equities, and things like that. And so someone said, we've got a great idea. If you put your money in railroads, now we know that because of railroads, nothing will ever be the same again. You know, that's completely changed the economy permanently, and so therefore we're going to put a lot more of our money into railroad shares. And that way we'll have enough money to start the undergraduate school in time for this deadline to join the Ivy League. And so guess what happened? You can guess that the railroad shares, just like the internet shares in 2000 and 2002, they collapsed more than twice as much as the overall market. And so they weren't able to start their undergraduate school for many more decades. In fact, they even lost a lot of the money that was going to be allocated to the graduate school. And so to this day, Johns Hopkins is not part of the Ivy League. So that shows that a decision based on a premise such as, because we have railroads, therefore asset valuations are going to remain artificially high. So to believe that because the Fed is doing this, because the Fed is manipulating, even if you're smart enough to know that that's not true, if you're running a hedge fund and you want to worry about outperformance, relative outperformance, as you mentioned, is key. If you underperform relative to the other hedge funds, you're going to be in trouble. So we say, well, okay, I don't believe this nonsense about the Fed, but if everybody else thinks that the Fed is manipulating the market higher, then I better get with the program and put most of our money in the S&P 500 so that everybody believes in this illusion, just as they can believe in the illusion that because of the internet, we're never going to have a bear market, or because of railroads or canals or steel or the other various innovations, automobiles that came along before previous bear markets. So I think that today, the illusion is in some ways stronger because usually those illusions would cause the stock market to become dramatically overvalued, at least in some sectors. Now we actually have the belief in the Fed causing the bond market, real estate, collectibles, and many other assets being simultaneously overvalued, so that if the stock market goes down, we're not going to get offsetting increases in price from treasuries, bonds, or other kinds of assets. They can actually all go down together, and I think that's going to be the big surprise. And it's a negative surprise because if you don't have increases in things like bonds to offset stock losses, you actually have a total net global loss of wealth. And that's something we haven't had really in a very long time on a massive basis. If we have something like a 40 or 50% total loss of global wealth, including real estate, bonds, stock, that's going to have a huge effect on the overall economy.